certainly gold, that's up the most. Crypto is second, and the dollar, and of course, long-term treasury bonds. So we're seeing those yields come down. The yield curve continues to flatten. I think we're at 25 basis points this morning. We don't have very far to go before inverted, and that has typically been associated with a recession.
Well, it's good to have you here. So let's talk about what's happening in the markets right now and what's happening in the fund, because Cathie, it's been said that you are in the toughest battle of your career right now. Not only are you fighting against the market momentum, you're also trying to halt huge losses and outflows. So I want you to address this for us. What is the message to investors here? Do you think that the street is just getting you wrong, or is it time to concede that mistakes have been made?
So let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible bear market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%, and we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. You know, this is a period, if you believe in innovation, and that innovation does solve problems. We had a preview of that after the COVID crisis, when our strategies in the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles, as opposed to gas-powered vehicles, would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns.
So what is the message to investors, though, who jumped on the ARK innovation bandwagon through the peak of the coronavirus, who are now looking at losses of around 50% through the course of the year? Pretty significant downside there and very hard to defend.
Consider the source, but what I do as an investor when I'm faced with a situation like this, where I have a high conviction strategy, I believe that innovation solves problems. We have a lot of problems. In that case, you average down into a strategy. And I have to tell you, you mentioned outflows. In February, we had inflows. And in fact, since January 17th, we've had significant inflows. So I think a lot of our investor base is averaging down. And as an investor, I've done that over my career, especially in innovation-related stocks. And you'd be amazed if you average down over time how quickly a strategy can come back above that average. And if we're right, significantly above that average over the next 5 years.
So talk to me about valuations, because the tech companies that you focus on that really drove the growth have been underperforming. In terms of what could happen next year, with regards to those valuations, you have said that innovation is in bargain basement territory. So when can investors expect a turnaround, and what will be the catalyst for that turnaround, particularly when we have interest rates likely coming up this month in the United States and oil now at $130 a barrel?
Well, I think valuations first. We expect our companies to invest aggressively now, sacrificing short-term profitability in order to capitalize on some of the most amazing exponential growth opportunities of our lifetimes. And I'll just give you one example of why this is happening. So there are 5 major innovation platforms evolving at the same time. Never happened before in history. You have to go back to the early 1900s, electricity, telephone, and automobile. We have 5, and what they're doing is converging. So we have one S-curve feeding another S-curve, feeding another S-curve. Take Tesla. We'll use that since we were so patient, and we were right, totally right on that. That is the convergence. Tesla is the convergence of 3 of those major innovation platforms. Robotics, because autonomous vehicles, which is the next big leg of growth for Tesla, are robots. Energy storage, they will be electric. And there's an accelerated shift towards electric now, given what's going on with oil prices. And artificial intelligence, autonomous vehicles will be powered by AI. So S-curves feeding S-curves, incredible growth opportunities. So if you look at the valuations today on our portfolios, again, we encourage our companies to accelerate their investing now, so that they can capture the lion's share of many of these winner-take-most opportunities. And so our valuations are roughly 85 times on this year if you take out the genomic stocks, which is a separate, distinct class here. And we have to do discounted cash flows on those. But 85, and our assumption is that that valuation will compress to 18 times on an enterprise value to cash flow, EBITDA point of view. So we have that in our assumptions. And despite that, we have return expectations, the likes of which I have never seen in my career, higher than any time I've seen in my career. The last time we were anywhere near this was at the end of 2018, when we had a terrible fourth quarter that the entire market did. And our return expectation back then at a compound annual rate over 5 years was 42%. And we did that. We did that. And here we are again. And one other thing I'd like to mention in terms of valuation, if you compare what's going on in the public equity markets to the private equity markets when it comes to innovation, we've seen a 60% drawdown in the last year. The private markets have seen a 20% increase as we have analyzed it through Crunchbase. So there's something wrong with that picture. I think the private markets understand that these opportunities, these 5 innovation platforms, are going to cause explosive growth opportunities. The public markets are filled with investors who are benchmark sensitive, especially during a drawdown. And so our stocks are not in the benchmarks. If you look at the S&P 500, for example, technology accounts for 28% of the S&P 500. Our overlap is 0.05. Those technology stocks are part of the success in the past. They are in the index because of past successes. Our technology stocks are going to be the future successes, and they will end up in the indexes.
So, Cathie, sounds like the bull case is still very much intact, at least from your perspective. I wanted to ask you about some of the other markers in the market right now, particularly as it relates to the war in Ukraine. Have we seen peak market impact yet, and what should investors be focusing on here?
It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index. And it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80. But we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. And so consumers are probably going to pull back. Sentiment suggests they will, and in some ways they already have. If you average over the last 3 months, this is U.S., consumption in real terms has been pretty flat.
Okay, so you're seeing recessionary risks rising.
Yes.
With regards to the war in Ukraine, investors are also seeing finance being used as a weapon. Shouldn't that be more bullish cryptocurrencies and Bitcoin?
It should. It should. It's been very interesting to watch crypto during this time period. If you look,
what role has it played, do you think?
Well, I think that more and more individuals are seeking insurance policies against confiscation of wealth. Confiscation of wealth can come in the form of inflation or outright seizure in Russia, for example, and other economies. So since January 31st, now these numbers are changing quickly, and we calculated them last week, but the flight to safety that we've seen has been in 3 places. Certainly gold, that's up the most. Crypto is second, and the dollar, and of course long-term treasury bonds. So we're seeing those yields come down. The yield curve continues to flatten. I think we're at 25 basis points this morning. We don't have very far to go before inverted, and that has typically been associated with a recession.
Also, Cathie, with regards to what we're going to see when it comes to this month, likely Fed hike, 25 or 50 basis points, what does it mean for your portfolio construction moving forward? We have about a minute left.
Sure. Well, I think Chairman Powell said 25 basis points. The market had discounted 7 or 8. And it's starting to rethink that. I don't think we're going to see anything like that. I don't. I think that this increase in energy prices and food prices is a huge tax increase on all consumers around the world. And that's more associated with recession than inflation.
Cathie Wood, it's been really fun to speak with you today. Thanks so much for joining us here on CNBC.